Where is it? Okay. So, very warm welcome again to everyone for the final bank and insurance capital tutorial. This is what I'm going to run through today. And so really just to answer many questions that you raised to me either privately or by email. So you still have an assignment to complete for HP. So please hand that in, one copy to Blackboard per team and one copy to VeryGuide per team by Friday. Okay. So we won't be doing a tutorial on the 22nd. Just let them stay at home and do some revision. Okay. So this is the last time today we will meet for this course, for the tutorial. So we have cleared up that question on actuarial appraisal value. So that's done. Sharima, nothing more to do. So deliverables, as you know, there is one due in 3 days' time. Now, exam logistics, you guys know very well by now, I hope, what we're going to do, you know. So on Friday, we will start the exam at 6:45. I would actually be happy to start earlier, but there are some part-time students, I think, who need to come from far away, because technically, the room is only booked to 9:30. And that's not me, okay? That is Chinese university regulation. They want you to go to bed early. I don't know why, okay? So try not to be late, okay? I'm not going to wait for anyone. So we will start on time. Venue is YIA, Lecture Theatre 8. So for those of you who do IPA on Friday morning, okay, you would know. It's just the classroom next door. No, for those of you who does Professor Fong's course on Friday, okay, that is YIALT 9, I think. This room is just the one next to it. Yeah. So we're going to start with Jason's part, which will be open notes, which will last for 82 minutes. And I will provide you the files, okay? So you don't have to, so I will provide the files for you to download and from Blackboard, okay? Probably they will be available like half an hour before the exam. You can go to Blackboard and they will be there. And I will set up an exam folder and you can download it from there, okay? So it's multiple choice and some short questions. There are some calculations. I think there are calculations with all sections of this exam. And after 82 minutes, I will take away your section 1, okay? So by that time, you have to shut down your PC or your laptop, your tablet, and then you get on with section 2 and 3. Is everyone okay with that? Yeah. That there are some, I think there are some calculations in section C. Okay, but just very simple. I mean, you look at HP's slides, and you know, every time you see a page with numbers, you know, that's where there can be a simple calculation. Yeah, this is what we do, okay? And you will use the lecture notes that we provide to you, please, okay? And no Googling or WeChatting or WhatsApping or whatever, just those files in electronic format, please. Is everyone okay with that? You want to ask me anything on the exam? Feel free. Any questions at all? I mean, not the actual questions, but anything about the logistics that you would like to know more? No? It's all quite clear? Sure? All right. Now, so concept check. So this one was already in the notes last time. I think this is the minimum sort of checklist that you really should be familiar with. And yeah, insurance capital and solvency calculations. Okay. And then for Cherie, so you know very well, she's just got one lecture file, which we can't give to you, okay, for the exam. Now, I did talk to HP, trying to get an idea of what his part might be like. I mean, it should be absolutely obvious to you. All you got to do is go into his files and look at them. And you know how he's given you 3 files, right? I think the last one is practically not examinable because he barely touched on it on Friday, remember? Yeah. So all that stuff about repo, which I would love to talk about, okay, unfortunately, we ran out of time. So mainly just credit ratings basics, which we also went through in the tutorial. Rating migration, do you know what it is? Default probabilities. Securitization, he talked quite a bit. And we will revisit some of those concepts in just a moment, okay? Like, why do you want to securitize, and what are the risks, and also what do you gain out of it, okay? Concept on tranche credit exposure. I'll come to that in a moment, okay? The concept is a little bit more complicated than you think, okay? And then capital consumption on the back of that. It's all about capital, mostly. Securitization is all about saving capital or making your capital work in a very efficient manner, okay? Asset-backed commercial paper, okay? So the exam strategy, apart from, I think students often, they are satisfied that they walk into an exam room and they know what is this, what is that, what is securitization, what is risk-weighted capital. I think at a master level, when you are soon to be joined in the professional world, the what part is not enough. Not for the exam purposes or for this course, the what part is not enough for you to become a professional. Okay, that's what I mean. And we want you guys to be professionals. So we ask a bit more than that. And I think the session today, the things we talk about, you will get a feeling what I mean by what, the what part is not enough, okay? Just a quick note on default probabilities. Now, we commonly define BBB minus as the sort of cutoff point. You know that, right? So above that, we call it investment grade, or sometimes IG. And once you dip below, okay, if you were BBB minus and you got downgraded, what's the next one? After BBB minus, what comes after that? Sorry? CCC, not that fast, no. BB plus, okay? Wow. You jumped several steps, but good try. Well, if what comes after triple B is triple C, then what is above that should be triple A, which is clearly not true. Okay, there's double A and there is A. Okay, and within these there's plus and minus, as you know. So between double B and triple B and triple C, you can guess. Okay, there's double B, there's single B. It's already pretty bad, honestly, when you get down to, well, you know, once you get down here. Okay, even triple B at the bottom end of investment grade really isn't that hot, you know. So there are various names, okay, that you call it junk bonds if you're not polite, or you can call it speculative grade. Sometimes, if you want to be polite, you call it high yield. Okay, these all mean more or less the same thing. Now, why is the triple B cutoff point? I use the word demarcation, which is just another word for cutoff point. Why is that? What is the significance? You know, why triple B is the point where people pay attention to? Do you think? You know what I'm saying? If you look at this chart, okay, which is actually I sourced that from HP's slides. You remember it's in there, okay, and this page. Now, you know what this is, I hope, okay. It is the probability of, for example, here is the 1 year credit migration matrix. So between the years 1981, 2017, a 36-year period, if you were triple A this year, the chance of you remaining as a triple A next year is somewhere around 87%. Okay, you guys know how to read that? You're okay with this, yeah? So if you are triple A, the chance of you suddenly becoming triple B next year is very small. Okay, it has happened though. Can you name a company that was once triple A and then it just suddenly collapsed like a heart attack? Can you think of any company? Nokia. I'm not sure if Nokia, well, they might have gradually, but I have a more extreme example. Have you guys ever heard of this one? Enron. Now, Enron was an energy company, and they were like, you know, the superstar in the U.S. energy market. They were huge for a while. They might even have been in the Dow Jones, certainly in the S&P, and they were AAA rated, but they were run by a bunch of crooks, and eventually people discovered, and they went bankrupt. Okay. Now the point here is, if you look down the diagonal, okay, you see that if you are double A, there is a 87% chance you remain double A. If you are single A, there is still around, in fact, these two numbers are quite close. Around 87%, you stay the same. If you are single A, in fact, there's a high chance. If you are triple B, it's still around 86% chance that next year you're going to remain as a triple B. Look at this one. So suddenly there is an 8% drop in the probability that you can retain your credit rating the next year. And then, so that is why this is a gap. Are you with me? Yeah? and then you can see that things just kind of get worse, okay? If you are triple C, there is 43% that you can remain triple C. And I told you my view on that last time, okay? You remember what I said? What 50-50, what 50-50 really means, huh? 50-50 means this, doesn't it? It means this, heads or tails. That's what 50-50 means to me. So for me, for my money, 50-50 is not good enough. I'm so sorry. Okay. Now you can disagree with me, but I would expect if you are down there at triple C, things are looking pretty bad. Okay. But one criticism of rating agencies is that they can tell the good from the bad, but it's a lot harder to tell the bad from the very bad. If you look at this chart, okay, you see a similar kind of gap risk, if you like, here. Now, it may not be so obvious. Now, okay, can someone explain to me what this table is? Last chance you can get some participation points. This is actually the last tutorial I am running for this term, guys. Sir, yeah. Very good. This is the cumulative default probability, okay? So if you look at a bunch of triple B firms, then within 10 years, around 3.5% of them would have gone down, okay? Now, I think this is what's sometimes called ratings migration table, okay, or ratings transition table. And this one is a cumulative default probability table. And it may not be so obvious in the short term, but once you get to like 5 years and beyond, okay, you can sense that the pattern is starting to show up. So if you're AAA, a bunch of AAAs within 5 years, you know, the default rate, okay, I should use the word rate sometimes. The default rate is 0.35. So in 1,000 companies, 3.5 of them may default. Double A, in fact, the number is lower. Isn't that interesting? Okay. But still quite low. And you can see there's not really a lot of change from AAA to AA, even to single A, to double to triple B. Now, what happens when you jump down here? Now suddenly you see that things get a lot worse. Okay. Are you with me there? Yeah? So I think that's what HP wanted you to appreciate. Okay. Just very quickly on securitization. So like I said, this is not really a class on securitization. But it is something that, okay, now what is securitization? In the end, the idea is really very simple. And the idea is if you are a bank or a lender of some kind, and you lend to people on the street and they buy houses and you give them a loan, so you create some kind of a mortgage pool with all these loans in it. It'll be hundreds, thousands of loans, okay? So if each loan was $10 million, and in Hong Kong, a mortgage can easily be $10 million, then 100 loans will already be $1 billion Hong Kong, okay? So you look at any apartment, maybe even the one you're now living in, 100 units, okay? It's not even one apartment block. So that's already a $1 billion pool. So you put all those loans into a portfolio, okay? And then what you do is you issue securities on the back of it, okay? They've kind of turned this upside down. I don't like the way it's represented, but typically what you would do, the process is simply that, so if there was a bank originally, and so this is the bank balance sheet, and that says on the, so that the mortgages will be on the asset side, mortgage, G-A-G-E. So what you do is you take that out and then you put that in a separate company, often called a special purpose vehicle. Okay, it's just a name for a shell company. So you put your mortgages come here, okay? So all your mortgages are now here. And then you will issue asset-backed securities, ABS. Now, ABS is a generic term for all kinds of assets, asset-backed securities. So MBS is a type of ABS, so that's mortgage-backed securities, but you can securitize a lot of other things. You can securitize credit card debt. You can securitize car loans. You can securitize student loans, and they do that in the United States, okay? You can even securitize corporate loans, okay? And sometimes these are, when you securitize corporate loans, there's a special name for it, and they're called CLOs. Do you know what that stands for? CLO? Collateralized loan obligation, yeah. Now, so you do that, and then there will be a junior tranche here, which typically is an equity tranche. So what that means is if you had a $100 million portfolio, and then you put that over here, so the notional outstanding, the outstanding amount is 100, and it may be that the asset-backed securities are issued with a face value of 90, and the other is 10. There is no guarantee that the equity investors will get back 10. That's why it's called equity. Okay. Now, so this is the basic. And the reason I said I don't like this diagram, they actually turn this upside down. The unsecured part is on top. Whereas in my diagram, I always like to have the equity down here. Okay. So when you look at this diagram, when you get home, okay, these slides are actually there on Blackboard already. Okay. So they turn this upside down, but don't worry about that. Okay. So now the thing I want you to understand most about securitization is to do with tranching. Okay. Now tranching for me is a concept that is at the heart of securitization, and it really defines the whole concept of risk redistribution. And I hope that if you at least understand this. Okay. Now, if there's no tranching, okay, all right. So you can see that there are actually, if you look sideways, so there are 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 loans. Now, if there is no, suppose there is no tranching, and you get 10 investors to participate in this. When there's no tranching, it means, and classically, when they first invented this kind of financing technique, there was no tranching, okay? What that means is if you have 10 investors, then you simply have, you have all of them lined up like this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. How many people have I got? 8, 9, 10. All right. So you got 10 guys, and let's say a bunch of mortgages defaulted. Okay, so these all went bad, all of them. Now, if this was like 10% of the pool, let's just say it is, okay, then this 10% loss will be shared amongst all of them. So let's say your original pool size is $1 billion. Let's just say it is, okay, that the amount doesn't matter, okay, and then you suffered a 10% loss because so 100 million of the loans have gone bad, and these guys all invested 100 million, all of them, okay, $100 million each, and they will all suffer, each of them will suffer a $10 million loss. Is everyone okay with that? That's when you don't have tranching. Without tranching, everyone suffers equally. Now, when you have tranching, you are investing like this now, okay? So the credit risk profile without and with tranching is what I call essentially a risk distribution or redistribution story. When you don't have tranching, the risk is equally shared with all the investors. But when you have tranching, then some people will take more risk and some others will take less. Okay, it's like a balloon, you know, and there's air inside. There is only so much air. If you squeeze one end of it, the air goes somewhere else, okay, but the amount of air is still the same. Are you with me? This is kind of what we are doing here. So if you have tranching like this, for example, so typically when you issue a NBS bonds, there are different tranches. There can be a AAA, and then a AA, single A, triple B, and so on. And then this one will be the equity tranche. The difference now is the investors are not lining up sideways like this. The investors are stacking on top of each other. So there are guys here, and then one will be here, another one here, and then finally there's some guy at the bottom. Now, maybe you're thinking, well, I don't want to be at the bottom, okay? That is the equity tranche. They call it residual. But guess what? They pay you more, okay? So it is entirely your freedom. If you don't want high risk, okay, get something like this. So I think you can probably imagine just by looking at this that this entire pool itself may have an average credit risk of let's just say A minus. This entire pool, okay, maybe A minus, but because you are kind of squeezing it, so some people take more risk down here, some people take less. suddenly you can redistribute, and from a pool of assets that may have been A minus, let's just say A minus, okay? Suddenly you can manufacture, risks with different degrees of credit quality suitable for different people's tastes. Are you with me there? That's the idea of tranching, okay? Is everyone okay with that? Yeah. I want you to get to know this, not for passing the course. Some of your alumni have gone into structured finance and they're really enjoying it. And I think they managed to go in because they had some knowledge of this and they were able to talk about it. Okay? Now, that's just a basic. Now, this is in-depth. It's not really in-depth, okay? But it's in-depth relative to what you just saw. Everyone okay so far? Yeah. So I say that the key motivation behind securitization is usually to do with balance sheet management or making it more efficient, and to free up capital for other usage by getting rid of, that's not Pratt, part, not Pratt, part, AR, part or all of credit sensitive assets. Okay. You guys okay there? You want to ask a question? Sure. Feel free to do that. Okay. So because you are freeing up capital. Remember, when you run a bank, for every single dollar that you are lending out, okay, you need to have capital set aside for it. It's not really a case of, bankers don't go to work and they're counting, they're counting every single loan they have. And then they are saying, okay, for this loan, I need this much. For that loan, I need that much capital. But when you look at the entire pool, and it could be like, $500 billion, then you get an idea how much capital you need. But whether you have $500 million lent out or $500 lent out, the idea doesn't change. You're just adding more zeros to it. Okay. Now, so what actually can happen if you have a bunch of mortgages, and then you do like I said. Okay. Now, first of all, the result of doing something like this is that people will purchase from this SPV. People will purchase from this SPV these securities, and they will pay cash to this SPV, and the SPV will pay the cash to the bank, because the bank is actually selling these assets to the SPV. Okay, so the SPV gets cash, and then give it to the bank, and then the bank will offload the mortgages. Okay, so the bank doesn't have that risk anymore, except sometimes if you are a customer of the bank, if you have taken out a mortgage, let's say with Standard Chartered. Actually, in the United States, this is quite common. So you borrow from Citibank or BOA or JP Morgan, they turn around and they will sell your mortgage to somebody else, and you wouldn't even know about it. Or maybe you don't care, you don't want to know, okay? And I think that was the problem with the subprime and the global financial crisis 10 years ago, was exactly that. But JP Morgan, so let's say you borrow money from JP Morgan, so they will be the one who will continue to surface your mortgage. Okay, now what that means is they're going to send you statements, they are going to calculate your interest, and if you're late, they're going to be the ones who pick up the phone and call you, and they will monitor your payments and so on. And this is actually called servicing. Mortgage servicing right, by the way, is a term, just for your knowledge, okay? So if you borrow from JP Morgan to buy a house, and then they turn around and they sell your mortgage to somebody else, but they are still servicing your mortgage, so you are still their client, that is called mortgage servicing right. And JP Morgan actually gets paid for that, okay? They get paid, let's say 50 basis points a year, just by providing that service. But they don't take any credit risk. So it can be a very good business, okay? You still have the loan in front of your client, the borrower, but it's not actually your credit risk, okay? Now that's known as mortgage servicing rights. And then the other thing is, if you were to keep the equity tranche, what actually are the exposures that you face? And how do you quantify then the required capital on the residual equity risk? Okay. Now, would you like me to just quickly explain? Because HP was talking about it on Friday, and I got the feeling that some of you got a little bit lost when he was talking about that part. Did you get it, Hunt? You know, okay, what was the question? The question was, do I talk about that in the next slide? The question was, you lend $1 billion to many companies. Now, it can be mortgages, it can be it doesn't matter, okay? You lend money out, and you lend money to a lot of borrowers with 100% risk weight. You lend $1 billion. How much tier 1 and tier 2 capital is actually required to back up this kind of loan book? Now, that's a very simple question. How much is needed? 8%, thank you. So if it's 100% risk weight, how much actual money do you need, or actual capital do you need then to back this up? I'll start you off. It's US dollars, okay? 80 million, thank you. 80 million being 8% of 1 billion times 100% risk weight. Well, this one is redundant, but I'll put it there anyway. Now, you now securitize this pool and you retain a 10% equity tranche. Everybody is still with me? You know what I'm saying? Okay. This, you now have, strictly speaking, $100 million exposure, right? So how much tier 1 and tier 2 capital do you need actually to back this up? That was the question that he asked, remember? Although he may not have used $1 billion, he was using percentages, and you guys were giving different answers. And some of you thought that it would be 8% of 100 million. Do you remember that discussion with H? Do you now remember? Okay. Is it 8%? Well, if it's 8% of this, it's 8 million. Is it? It's not? Why not? Why isn't it 8%? Come again. Say again.
Because the issuance of the securitization process.
Yeah.
Yeah, so the interest rate requirements for everyone. Not 8%. I remember.
No. 3%, that was on the just how much interest you can get from those loans, which has got nothing to do with it. Now, this, dollar to dollar, which means what? Which means how much capital do you need then? 100. All right. Okay, so we have 8 million. Is the arrow, right? And then Hunt says 100 million. Now between 8 and 100, there's a difference of 92. You think it's 10? Okay, and yet thinks it's 10 million. Now here, the is why I actually talk to you about the tranching first, okay? My emphasis is that if you are not investing standing up, oh, where are all those guys gone? If you are not investing standing up, if you're not doing that, and you are investing, sorry, if you're not investing side by side like this, but you are investing on top of each other, then let's just say you have perfect foresight and you predict that this pool is going to suffer from a 10% loss, and you know that, okay? Now, in this instance, everybody will get a 10% loss. But here, actually, this guy is going to take all that 10% loss. So in other words, although, you see, this is why credit is such a fascinating asset class. It really is. Although your exposure might be, just $100 million, okay? But you run the risk of losing all of it, okay? That is your worst case. Whereas if you were here, the chance of you, now here, what is the interesting thing? The interesting thing is each of them also is investing 100 million, but the chance of them losing all of that is a lot lower than the chance of this guy losing 100 million. Do you understand? Yeah? That is the key point about tranching. It really is an art because it's risk redistribution. And, if people are not in this line of work, they don't understand. They say, well, how come, here these guys are investing 100 million. So their worst case is they lose all of it. Yes. And then this guy here, all right, his worst case or her worst case also is 100 million. Yeah, but this worst case is a lot more likely to happen because they're right at the bottom. That is the difference. Okay? If you understand that, I think you get the key point about securitization. Now, he then went on, HP that is, and then he went on and he asked you, and I think if I just show you, okay, we were up to this page. I'm going to show you the next page now, okay? So you now have, it's the same question that was in the previous page, okay? The answer is not 8 million, okay? I'm talking of a $1 billion pool, okay? Okay, let's go back. You have $1 billion pool, that's 1,000 million. You securitize it, and you keep a 10% equity piece yourself. So you keep $100 million of that. So the question is, how much tier 1 and tier 2 capital? You may think, all right, well, I have kept $100 million exposure and is 100% risk weight. Then it is simply $100 million multiplied by 8%. Now, if you thought that, that would be wrong. That's not correct, okay? You now have $100 million out there. How much tier 1, tier 2 do you need? It is not 8% of 100. It is not, okay? The reason is, like I said, okay, although your exposure is reduced to 10%, it is far more credit risk sensitive. Okay, it is a more intensive credit risk, as you are now taking the first hit. Okay, are you okay there? I want to make it simple so everyone gets this. Okay, the answer I'll show you the answer in a moment. Okay, thank you. Did you hear what he said? Yeah. All right. I'll show you the answer. Okay. Now, let's just imagine, I mean, this is not how they do it, but let's just pretend it is, okay, that the so-called 8% requirement comes from a 40% loss given default. Okay, so you have a loan, and if a loan was to default, then you're going to lose 40%. That's the 40% LGD, okay? And there is 20% chance of that happening. Excuse me a moment. And there is a 20% chance of that happening, okay? So you multiply your expected loss by the probability of it happening. It's equal to 8%. Now, I'm not saying that this is how that is why they come up with a tier 1 plus tier 2. I'm not saying that, but let's pretend that is how they do it, okay? Then in a $1 billion loan, the expected loss will be 80 million, okay? And then, so if you were required to back up that loan pool with $80 million, you just about cover the loss, let's say, okay? Again, for the third time, this isn't how they do it, but let's just pretend it is, okay? Then the capital that you have will just about cover the expected loss. Now, if you hold, I'll rub that off. If you hold a $100 million equity tranche, you cannot actually support that with 8 million of capital, because the expected loss, and I already told you, the expected loss is 80 million. It's going to wipe it out. You are $72 million short if you only had 8 million capital lying around. Because if this really is the expected loss, then you are the one that gets hit first. That's the key point. It's going to hit you first before anyone else. Okay, so to put this in a clear, clearer format, this is what would happen. Okay, so if your equity tranche size, I'll start here. Okay, if your equity tranche size was 100 million, which is 10% of the pool, the capital that would be needed would be 80 million. Now, why 80? Because this 80 was the original amount that would be enough to support the entire pool. The entire pool. Remember that? That was what Hunt told me earlier, right? So if you support just a part of it, it doesn't make sense that you should need more, okay? You should need less, but you should not need more, all right? So that's where it's actually capped. Are you with me? Do you understand what's going on here? So if you only invest, okay, if your equity tranche was 200 million, so the original pool was $1,000 million or $1 billion. If you take up 20% of that, that's 20%. So you retain that piece, okay? Then the amount of capital that you would need is still just the original 8%. So that doesn't change. So that means you go dollar for dollar. So you back up 100% of your exposure until you actually get up to that 8% threshold. And then it levels off. Are you with me? If you have a $1 billion pool and you have 1% of equity, there's a very, very high chance you will get wiped out. Okay, so that is why they want you to fully back it up, dollar for dollar. Yes. Yeah. Why? What were you thinking? No, I think you're mixing it up a little bit. This is okay. All right. You've got to understand what is going on. Okay, so here is a big bank. So they have here's a bank, and they will sell off some of their loans, which are worth $1 billion. Okay? Yetta, I'm going to write those words in a moment. Okay? Now, originally, okay, this is before. So they would need down here, how much capital do they need for a loan pool like that? They need 80 million, correct? Tier 1 plus tier 2. Now that's very simple. This one, Ziheng, actually he already told us 10 minutes ago. Everyone is okay with that? Yeah, so this is tier 1 and tier 2 capital. I'm sorry, sometimes this is also known as equity. And I think you are getting mixed up between equity and the equity tranche. Okay, now I will clarify that in a moment. So sometimes when I'm using this vocabulary, it can create confusion. What you now do is you sell this. Okay, so this is step 1. Step 2, you're going to sell off these loans, but you are going to keep 10%. Okay, now how does that work? So that means number 2, so investors are going to pay you $900 million which so I'm going to try and draw it roughly in scale, okay? But now this will be turned into $900 million in cash, and then $100 million is the so-called equity tranche. Now I'll show you what that looks like, okay? So if you look at the SPV itself, what you have done is you have moved these assets over here into the SPV. Maybe I'll use a different color. What color would you like? Blue. Okay, so these blue bits might be easier. Yeah, okay, so these blue bits, these are the corporate loans. Okay, $1 billion of corporate loans are now over here. All right, this is fun. I'm doing the coloring. Yeah. Oh, I like it. And then I'll continue. On the other side, all right, you issue asset-backed securities. You are securitizing it, so investors will be buying these, but there is an equity tranche. So 90% will be, thank you, sold to investors. 10%. Now I'm going to do this in red. Okay, so this one will be in red. You want purple? Which one is purple? This one. Oh yeah, purple. Right. Okay. So purple. I have to keep my customers happy. Now this purple bit is called the equity tranche. The equity tranche. Within this securitization issue is called the equity tranche. And for the bank, it is actually an asset that, where would you put that? I'll leave that question. Where does it belong? Hun, you want to come and draw? Oops. Come. Where? You draw it. Where does the purple bit? Where is the home? Where does it live? Equity tranche. Yeah. Where does it belong? Find a home for it. You draw here.
I know. Yeah. This is the.
Yeah.
Sorry. It's the equity, I think. Yeah. How much?
This is actually an asset. Okay, this is an asset for the It's an equity tranche, but it is an asset.
10% is 100 million, right?
Yeah.
Yes.
No, it's not there.
Uh,
On the left? Okay, you come and draw it. I think she knows.
You see it in the.
Draw. Very good. Yeah. That's where it is. You get it? Are you guys okay with that? Okay, so now the bank has retained this piece. So they retain the equity piece. Now, the story doesn't end there, ladies and gentlemen. The story doesn't end there because I still have a final question I need to ask you. Now, this is, so this part is now cash. And strictly speaking, you actually can use the cash to pay off some of your debt. So your balance sheet eventually the size might go down, and this part could disappear. Okay, but leaving that aside for now. Okay, and so the question now is your equity down here. So previously you needed 80 million. The question now is how much do you need now? That was the question. How much capital do you need now? That's what we've been discussing. And as it happens, if you retain a 10%, so the loan was $1 billion, and you keep 10% of it, so you keep 100 million, actually you still need all the capital. You need as much as you ever did in the past. You still need 80 million, okay? But if you keep a 20% equity tranche, your required capital does not go up, okay? The interesting thing is if your equity tranche was smaller than 10%, let's say 9%, 8%, once it gets below 8%, then it becomes interesting, but you have to back it up dollar for dollar. And the reason you have to back it up dollar for dollar is because your equity tranche has a kind of, magnified credit risk because you are the first one to get hit. That's always the point to remember. You are the first one to suffer. And it's like, you know what a bumper is, right? The car bumper. You are the bumper. You know what a bumper is, right? So you take all the frontal impact. Yeah, before anyone, and think of it like that, okay? Okay, is everyone okay with that? So make sure you understand this table and what's going on here. The numbers are not not too hard to read, but trying to figure out, the logic behind it, is very interesting. Yeah. Yeah.
Loss for dollar for dollar, that the required amount is 80 million. So if you're looking more than 80 million, you just need to take 80 million of your equity to back up any losses.
Correct.
So,
yes.
In that case, does that mean that the change that is higher than the equity change will have higher rating instead of triple B minus or something? Like that means if you're holding more equity, so you definitely going to cover the losses of 80 million, and the change higher than the equity will be rated higher.
Well, I think that's a $2 question, which means you should get $2 for asking a question like that. Do you understand the question? I think I understand the question. The question is, when you securitize and there's a pool and there are different ways you can cut it, yes. So you can go 90-10. You could even go, so there's 90-10. you can go 80-20, 80-20, or even 70-30. Now, as you can probably figure out, the more, this is like, I call it the bumper, or the, like an airbag. So the thicker the airbag, the safer the guy on top. Yes. So if you have a structure like this, let's say, and you can do a securitized issue with just 2 tranches, you can do that. And let's say if this one was rated, if this one has a rating, and the rating was, let's say A+, okay? If you use the same pool, exactly the same pool, but you cut it like this, the rating of this tranche can well be AA, and this one may even be AAA. Was that your question? Is that your question? Yeah, exactly the same pool. You can do that, yes. So you might be wondering, if you are holding the equity tranche, okay, then which one would give you, which one is the optimal? Well, actually, it depends, because there are two considerations like this. Consideration 1 is, so this pool, originally, it belongs to you, all of it. Now you're going to sell part of it. You're going to keep part of it, okay? Now, so consideration 1 is the credit rating. So if the rating is high, then the interest rate that you have to pay investors would be very low. So that is good. The investors, these guys, okay? So that's the good part. The bad part is, if the rating is very high, okay, then you do have to retain a larger equity investment. So even though, which means this one is bigger, okay? Now your capital might be the same, but this one is bigger, okay? So your exposure is higher. Even though from a capital point of view, it doesn't change. And I think if you are securitizing something, usually you really try to get your equity involvement to be as low as possible, preferably 0 if you can, okay? That's the whole point. You want to try and get rid of the exposure completely. And I think quite often banks will take the equity piece because nobody else would, okay? So somebody has to take that risk. So the bank says, all right, okay, we'll handle that. Otherwise, you can't do the deal, for example, okay? Now, yeah, so this is just tossing around. So I'm asking here some questions. If you look at the table previously, this table here, okay, if you look at this carefully, if you have US dollar 20 million in capital, if that's all the capital you have, then that is the amount of equity you are allowed to take up would be 20 million. So you would have to sell down the other 980 million. Okay, that's my point here. But if you have 80%, if you have 80 million in capital, you can take up a 10% equity tranche. You can also keep the entire pool. You can keep the original pool. So why would you securitize it? Okay, that's my question. $80 million is actually the cap, as you can see. the capital required for your involvement in this pool is 80 million and no more, because it started at 80 million, okay? So typically, banks, when they are involved, they would prefer to be involved as little as possible, okay? Now, so why would you actually be somewhere here? Why would you do that? That's my question, okay? And I try to give you some answers. And these were actually mentioned by HP. I don't know if you caught what he was saying. Maybe that was getting late towards the end of the evening. He mentioned these reasons. Maybe you don't have a choice, okay? Because if you don't do that, then nobody else would buy the equity, and the senior tranche may get a better rating, okay, when you are involved as an equity investor, and the yield might actually be quite attractive, okay? And I have here a very, yes. Where does the yield come from? Okay, this is a calculation. You can read my mind. I'm getting into that, okay? Now, this is similar to, I think what HP was showing. I'm not using the exact numbers, okay? Let me explain to you what is going on here. So I have a pool, a loan pool, $1 billion loan pool, and the pool will pay interest at 5%. This is the pool, all right? So there are $50 million a year for everyone to share. Now, I just cut this pool into two parts. So there's the equity tranche, which currently is 8%. So the senior tranche is 92. Let's just say I do that. Let's just say I do it, okay? And let's say they require a 3.5% interest rate. This is the investors for this pool, okay? Let's just say they do, okay? So the interest you have to pay to the senior guys would be 32.2 million. And then the remaining income is 17.8, which is 50 million minus 32.2. Now, all that goes to the equity tranche investor. So 17.8 divided by 80 is 22.25%. That is the yield, okay? I'll give you another example. Do you understand what I mean by the yield? Sorry, Liu Ye, right? You know what I'm saying? Do you understand this calculation? Now I knocked out a little very, very simple. That table came from this spreadsheet, which I'm happy to load up, but it's not much of a spreadsheet, honestly, okay? So your pool size, $1 billion, and interest rate 5%, senior tranche 92%, equity is 8%, and the senior guy said, I want 3.5% if there is only an 8% cushion under it. All right. So they want to be paid 3.5%. Now let's just imagine you go back and you renegotiate with the with the senior people. Now you tell them, look, how about I take up a 10% equity tranche. So now you have a 2% extra safety in your airbag or your bumper. So you will only need to invest 90%. Would you mind to take a 3% interest rate? Okay. Suppose they say yes. Now what happens? What happens is now the interest from the pool, that doesn't change, all right? But now they take up 90%, so I'm going to change the 92 to 90, and they are happy to be paid 3%. Your yield has gone up now to 23. Can you see that? What was it before? 22 and a bit, wasn't it? So for that reason, you don't mind actually to invest a bit more in the equity tranche. Although, like I said, most of the time, I think when you securitize, you just don't want anything to do with it, honestly, okay? Is everyone okay with that? I can give you this spreadsheet, you just go home and play around with it. Huh? Yeah, sure. The equity return is something divided by F12. F12, of course, is your equity. It's something divided by 100 million. What is it? It's just the total interest income minus the senior interest income. As I'm writing this, you can see the formula on the top left-hand corner, can't you? Yeah, up there. I'll give you this spreadsheet. Only took me 10 minutes, okay? It should only take you 10 minutes. If you can figure out what's going on here and you understand what I just said to you, I think you know much more about securitization than when you walked into this room 90 minutes ago. So who asked that $2 question? Oh yeah, right. Yeah. And $2. All right, my last $2. Look for money. Are you guys okay? All very interesting, don't you think? Now, I think this is all I wanted to say for now. So what have we done today? So we had a bit of housekeeping, talked about the exam, talked about HP's part. We had a look at ratings migration, default probabilities. We looked at securitization basics. Then we looked a little bit deeper, why people do it, the central idea behind tranche credit exposure. I really hope you understand this one. I honestly do, okay? And then capital consumption. That is that table with all that 10 million, 20 million, 30 million, that table. And why does the pattern look like that? And then I showed you the spreadsheet, which I'll be happy to share with you, okay? Are you guys okay? You are now all bank and insurance capital experts. Well, not yet. After Friday, you will be, okay? Yeah. Okay. Yeah, I really hope you get something out of this because it is useful. and I find it fascinating. And even as an investor, you need to get this idea. And as you know well, the asset-backed market in China is hot. You know that, right? They need a lot of people. They don't have people. Yeah, and they need a lot of expertise. Huh? You know, so I want to thank you all for coming, and this is the end of our classes for bank and insurance capital. So I hope you enjoyed it, and I will put this online together with the spreadsheet. And if you have any further questions, feel free to let me know. Oh, and I'll make the video available as well. Okay. All right. Thanks, everyone. Thank you. Can I have my dollars back, please? Bye bye.